Welcome to the deep dive. So
Yes.
you've brought us this May 2025 report from the macro Butler.
That's the one.
And our mission, as always, is to basically cut through the noise, pull out the really key insights, and, give you that shortcut to understanding what's going on.
Exactly. Think of it like we're unpacking the suitcase for you.
Yeah, I like that. So today, we're digging into the economic signals from May 2025, what the data really said, what it might mean for investors, for you, and maybe find a few unexpected twists.
Definitely. We'll look at the hard data, but also, how the market's reacting. Because sometimes, the data says one thing and the market seems to be dancing to a slightly different tune, at least for a bit.
So true. Okay, let's crack open this macro Butler analysis then.
Let's do it.
First up, the report dives into the May payrolls data. Now, the headline for April came in at 177K jobs. Better than some people feared, maybe, but still softer than March.
Right. 185K for March after revision. So yeah, a bit softer. On the surface, you might think, okay, holding steady.
But the report says, hold on, look closer.
Yeah, exactly. This is where it gets interesting. The report flags what look like early signs of, trade war impacts starting to bite. Manufacturing actually lost 1,000 jobs, and retail dropped 2,000. Now, that's a reversal from gains we saw before. Plus, federal jobs dipped too because of hiring freezes.
Okay, so underneath that okay-ish headline number, there are these specific weak spots showing up.
That's what the source argues, and it points out something subtle. The headline number might look a bit better than reality because folks getting severance pay can still be counted as employed for a while.
Ah, okay, so it masks some underlying churn.
Potentially, yeah. Now, don't get me wrong, healthcare, business services, they held up okay. But the overall vibe the report gives is a job market that's bending is the word they use. Not breaking yet, but definitely bending.
Bending, not breaking. I saw there were some brighter spots mentioned, though. Average hourly earnings ticked up a bit, 0.2%.
Yep, and average weekly hours edged up too, to 34.3. Both actually beat expectations slightly, so, not all doom and gloom.
But then the report connects it back to the bigger picture, right, with the unemployment rate.
Exactly. The rate stayed put at 4.2%. But, and this is the key point the source makes, it's been above its two-year moving average since way back in September 2023.
Okay. And historically, what does that usually signal?
Well, history suggests that when the unemployment rate stays above that two-year average for a sustained period, it tends to mean economic clouds could be gathering, maybe trouble brewing over the next 12, perhaps 24 months. So it's not just the level, it's the trend versus its own recent history. What stands out to you there? It's more nuanced than just the monthly number.
Yeah, that context, the historical perspective is crucial. Okay, let's shift from jobs to, spending. April, retail sales. Nominally, the headline beat expectations. So good news, right? High fives all around.
Well, nominally, yes. But this is where peeling back the layers gets really fascinating, looking at what people are actually buying. Spending dropped, and pretty significantly, on goods that are sensitive to tariffs.
Ah, okay. Like what?
Yeah. Things like sporting goods, building materials, cars even. Instead, consumers seem to focus their spending more on, the essentials and entertainment.
So they're still opening their wallets, but maybe redirecting where the money goes because some things got pricier. Makes sense.
Pretty much. And the report throws in that crucial reminder, these retail sales figures, they're nominal. They don't account for inflation.
Right, that pesky inflation detail.
Pesky indeed. And when you adjust for it, guess what? Real retail sales are still below their peak from way back in April 2022.
Wow, okay, so spending hasn't actually recovered in real terms. That's a really important distinction the headline completely misses. And the source ties this to market history, too.
It does. It raises this really interesting question for investors. Historically, peaks in these inflation-adjusted retail sales have often lined up with peaks in the S&P 500 to oil ratio.
Okay, the S&P relative to oil prices.
Yeah, and when that ratio peaks, it often signals that it's about to drop below its 7-year average, which, historically speaking, has often been an early warning sign for an approaching recession. So the report asks, what does this subtle hint suggest about how close we might actually be to a downturn?
Food for thought. Okay, speaking of inflation, let's talk about that elusive 2% target the Fed keeps mentioning. April CPI data came out after what the source amusingly calls Liberation Day.
Yeah, the day the data is liberated after the FOMC meeting.
Right, and it seems March's little dip in inflation was just a bit of a head fake.
Looks that way. The report confirms inflation bounced back in April. And, with tariffs still in place, policy changes. Someone's paying what the source calls the tariff tax. Either consumers are paying more or businesses are absorbing the costs, squeezing their margins.
And the report sounds pretty blunt about hitting 2% inflation anytime soon. Calls it a fairy tale for the end of 2025.
Yeah. Increasingly unrealistic is the phrase used, mainly because of those ongoing tariffs and also base effects, how the current numbers compare to last year's. The math they lay out is pretty sobering.
How so?
Well, even if monthly CPI increases just tick up by a tiny 0.1% each month from here on out, we'd still end 2025 above 2%. If monthly increases average 0.2% or more, well, then you're looking at year-end CPI potentially landing somewhere between 3.2% and maybe even 5.8%.
Whoa. That is a huge difference from 2%, and definitely not what the market seems to be pricing in.
Not at all. And connecting this to the bigger picture, the source argues, look, history shows inflation really comes down to three things: shortages, really strong demand, or a loss of confidence, in the currency or the policymakers.
Right.
And the concern is that tariffs and some of these policy changes risk making all three of those things worse, which obviously isn't great for the economy and could even hurt political support down the line.
And the report also pushes back against some common market theories about inflation, like the money supply one.
It does, yeah. It directly challenges the idea that the money supply M2 specifically is the main driver of inflation. It says the historical correlation just isn't reliable.
Interesting.
And same thing for another supposed correlation. The gold to bond ratio versus M2's annual change. The source basically says, nope, that correlation is effectively zero. Forget about it.
Okay, so inflation isn't going away quietly. How is this hitting companies then? Let's talk corporate pricing power. The Producer Price Index, PPI, what businesses pay for their inputs, actually fell sharply in April, like 0.5% month-on-month drop.
Yeah, versus expectations of a small gain. It was the biggest monthly drop since way back in the early pandemic days, April 2020. Year-over-year, PPI eased to 2.4%, the lowest since September 2024. And core PPI, a record drop apparently, especially in services. Trade service margins really collapsed.
So what does that mean for corporate profits? The story for a while was that companies were amazing at passing on costs, boosting their margins.
Exactly. That whole narrative about their knack for passing costs onto consumers and boasting about margin expansion, the report suggests that story is starting to look, well, a bit shaky based on this PPI data.
Because their input costs are falling, but maybe they can't raise their selling prices as easily anymore. Or maybe they even have to cut them.
Precisely. The key thing the source highlights here is the gap between core CPI consumer inflation and core PPI producer inflation. Think of it as a rough gauge of corporate pricing power.
Okay.
And that gap. It's been negative for 7 straight months now.
7 months. And what does that typically suggest for investors looking at company earnings?
It implies that businesses are feeling squeezed. They're facing pressure on what they can charge relative to what things cost them. Historically, that points towards lower operating margins ahead, and ultimately that can translate into lower valuations for companies.
That definitely puts pressure on those future profit expectations. Okay, let's move to the main act.
Yeah.
The Fed. FOMC meeting, they held rates steady, 4.25% to 4.5%. No surprise there.
Nope, widely expected.
And the report notes they kind of acknowledged the rising risks, even subtly blamed tariffs for some of the Q1 GDP weakness. Seems like they're juggling a lot.
They are, and this is where the source points out something really, really interesting from Powell's press conference. He was asked directly, if inflation stays high but unemployment starts rising, which mandate wins? Inflation or jobs?
Yeah, the classic dilemma. What did he say?
He basically admitted he didn't know, which, is honest, but the source calls it a rare, unspoken white flag from a central bank chief. Usually, they project more certainty, right?
Wow. That is quite an admission. It kind of bucks the whole narrative of the all-powerful Fed controlling everything.
It really does. Challenges that idea you often hear on Wall Street, that the Fed precisely steers the business cycle. The report actually digs into the history here, comparing the Fed funds rate to that S&P 500 to oil ratio we talked about earlier.
And what does that history show?
It shows a different story. Rate cuts by the Fed have actually often coincided with that ratio peaking, not necessarily preventing the peak. And more importantly, no cycle of rate cuts has ever stopped that ratio from eventually falling below its 7-year average, the signal the source watches for the shift from boom to bust.
So even when the Fed cuts rates, the underlying cycle still seems to play out according to this historical pattern.
That's the argument the source makes based on the historical data.
Okay, so Powell admits uncertainty. History suggests Fed control is limited. Yet the market And even the Fed's own forecasts, the dot plots, they still seem pretty convinced cuts are coming later this year.
It feels like a bit of a fantasy, honestly, based on the data presented in the report. The source actually runs the numbers using something like the Taylor rule, a kind of guideline for where rates should be based on inflation and unemployment.
And what does the Taylor rule suggest right now?
Well, plugging in current data, like core PCE around 2.8%, unemployment at 4.1%, the Taylor rule suggests the Fed funds rate should actually be closer to, wait for it, 5.99%.
Whoa, hang on, 5.99%. That's way higher than the current 4.5%. That's suggesting they should be hiking, not cutting.
Exactly. That's the massive disconnect the source points out. While the market is dreaming of rate cuts, the actual economic data, filtered through this standard framework, suggests rates might need to go up as the U.S. potentially transitions from this inflationary boom into more of an inflationary bust.
What does that mean for markets expecting cuts? That sounds like a recipe for a major surprise.
It implies a significant potential for market disruption if reality diverges that sharply from expectations.
Yeah. And this uncertainty, this potential disconnect, seems to be spilling over into the bond market too.
Oh, absolutely. The report highlights Moody's expected downgrade of U.S. sovereign debt from AAA. They see that as kind of the final nail in the coffin for this myth that U.S. treasuries are somehow magically anti-fragile, completely risk-free assets.
So the perception of safety is eroding, even for treasuries.
According to this analysis, yes. And you can see it in the yields. Since that Liberation Day CPI print, long-term yields have climbed noticeably. We're talking 20 to 45 basis points higher across the 5-year to 30-year part of the curve.
And the source reads that as the market losing confidence.
That's the interpretation, yeah. Waning confidence reflected in higher borrowing costs for the government. And the report argues, look, the Fed can't really control these long-term rates without firing up the money printers. Again, another big round of quantitative easing, QE.
You think they do that?
The source suggests it's probably inevitable, maybe not immediately, but eventually. Perhaps to bail out banks facing pressure, or even the government itself needing cheaper funding.
And those rising long-term yields, they don't just affect Wall Street and the government, right? They hit Main Street directly.
For sure. Rising 30-year Treasury yields inevitably push up mortgage rates for regular people trying to buy homes. That's pretty much baked in, regardless of other housing market chatter.
And the report draws a historical link there, too, between mortgage rates and the broader economy.
Yeah, what's fascinating is the historical pattern they point out. Elevated mortgage rates have consistently been a headwind for future corporate earnings.
Huh. Why is that? What's the connection?
Well, think about it. Higher mortgage payments mean households have less money left over for other stuff, discretionary spending goes down. Plus, rising rates and maybe a slower housing market can dampen overall business confidence. Both of those factors tend to eventually crimp corporate profits down the line. It's a broader economic signal, not just a housing story.
Makes sense. Okay, one more piece. Liquidity. Often overlooked, but crucial. The Fed is still doing quantitative tightening, QT, shrinking its balance sheet, right? Slowly.
Yeah, still tapering, about $5 billion a month last I checked. But there's another wrinkle. The Treasury is actually reducing how many short-term bills it issues, partly due to debt ceiling mechanics. That adds another layer of uncertainty to U.S. dollar liquidity conditions.
So less liquidity sloshing around from both the Fed and the Treasury.
Potentially, yeah. Now, the report mentions that if markets get really volatile, we might see a liquidity Fed put, basically the Fed stepping in with temporary measures to calm things down.
Like a quick injection of cash to stop a panic.
Right. But the source emphasizes something maybe less visible, what it calls shadow liquidity. These are sort of the less official, non-Fed, balance sheet ways money flows through the system, the stuff that really fueled market exuberance over the last few years.
Okay. And what's happening with that shadow liquidity?
It continues to tighten. And this is where the report sounds a pretty loud warning bell. It highlights that historically, this specific kind of tightening the drying up of shadow liquidity has often been a leading indicator.
A leading indicator of what?
Looming banking crises.
Wow. Okay, so pulling all these threads together, the softening beneath the jobs headline, the weird retail spending patterns, sticky inflation, margin pressure, the Fed's dilemma, rising yields, and now tightening liquidity, especially the shadow liquidity. What's the bottom line conclusion from the source?
The bottom line is that the risks of the U.S. economy shifting gears, moving from the inflationary boom phase we've been in into an inflationary bust or stagflation phase are significantly increasing. And that shift could happen, they suggest, within the next, say, 6 to 9 months.
Okay, so that brings us to right now. Where are we, according to this framework? As of late May 2025, The report says the U.S. is still technically in that inflationary boom quadrant. Been there since May 2023.
Correct. And the playbook for that specific environment, based on history, has been own equities, own gold. That's been the recommended stance.
Sense a but coming.
There's a big but. This is where the report really gets interesting, almost flashing a yellow, maybe even red light. Remember that S&P 500 gold ratio?
Yeah, stocks relative to gold.
It actually broke below its 7-year moving average back in late January of this year, 2025.
Okay. And the source makes a big deal out of that specific signal.
A very big deal. They are crystal clear on this. The report states that every single time this ratio S&P 500 to gold has broken below its 7-year average.
Yeah.
Think early 1970s, early 2000s, even that brief dip in January 2020. It has never been a good omen for risk assets. Never.
Never been a good omen. That sounds ominous. Why is that particular ratio, stocks versus gold, seen as such a critical signal in this framework?
Because historically, it's acted as a leading indicator. That breakdown in the S&P 500 gold ratio has typically come before a similar breakdown in the S&P 500 oil ratio by, maybe a few months.
And it's the S&P oil ratio falling below its 7-year average that signals the shift into the actual economic bust phase.
Exactly. That's the signal the source watches for the economy tipping over. And again, that S&P oil breakdown has also historically never been a good omen for markets or the economy. So the gold ratio falling first is like the canary in the coal mine for the oil ratio potentially following suit. These ratios aren't just random correlations. The source treats them like sensitive thermometers gauging these big regime shifts.
Okay, so if we take this historical pattern seriously, if the S&P gold breakdown is indeed the warning shot, what does this imply for you, for investors, right now? What's the actionable takeaway?
Well, the source is pretty direct here. If history is any guide, and if that S&P 500 oil ratio does eventually follow gold and break below its 7-year average, then the playbook changes dramatically. From that point on, every rally in the equity market becomes a potential selling opportunity.
A selling opportunity. That's a major shift in strategy from buy the dip.
Huge shift. The focus needs to pivot significantly.
So how should that pivot look, according to this report? What should you be doing?
The suggestion is to focus on buying dips in energy producers, companies that benefit from higher energy prices, while selling into any strength in energy consumers, companies hurt by higher energy costs.
Okay, specific sector plays there. What about equities more broadly?
The emphasis has to be on quality. We're talking companies with strong balance sheets, low debt, low leverage, minimal refinancing risk, which is crucial if rates stay higher for longer. And really importantly, companies with high return on equity, the ones that can actually grow their earnings per share and free cash flow faster than the rate of inflation. That becomes paramount in this kind of environment.
Got it. Quality over everything else. And what about asset classes beyond stocks?
Gold and silver, the source explicitly calls them out as the appropriate core allocation for navigating what they see coming. An inflationary bust phase, basically stagflation. They even echo that old saying, gold is for war.
Gold is for war.
Wow. And what about bonds, usually seen as the safe haven?
Not according to this source, not in this scenario. They strongly advise avoiding long-dated government bonds.
Really? Why? Because the argument is that in an inflationary bust, traditional bonds might not provide the protection people expect. Instead, the source points to hard assets, things with inherently limited supply. Gold, silver, platinum, oil, base metals, even agricultural commodities. These, they argue, not government bonds, are the truly anti-fragile risk management tools when the economy potentially shifts into that inflationary bust regime.
All right, that was definitely a deep dive into the Macro Butler's May 2025 take. Quite a journey. We've covered those subtle signs of weakness under the surface of the job and retail numbers.
Yep, how tariffs are maybe starting to show up and that reality check on the whole 2% inflation dream.
Plus the squeeze on corporate margins. The Fed's surprising moment of honesty, maybe, and why history suggests their control over cycles isn't what Wall Street often thinks.
Right, and those clear warning signs from rising long-term yields, mortgage rates hitting Main Street, and that crucial tightening of liquidity, especially the shadow kind.
All of it, painting a picture, according to this source, of increasing risks that the U.S. economy could be transitioning from that inflationary boom towards more of a bust phase in the next, 6 to 9 months.
And the key early warning signal they're watching is that S&P 500 gold ratio already breaking down below its long-term average, something that's historically preceded the S&P 500 oil ratio doing the same, which is the marker for that economic bust.
Which then leads to that pretty stark strategic advice. Potentially selling equity rallies, focusing on quality, playing energy producers against consumers, and really leaning into hard assets like gold and silver while avoiding long bonds as the potential anti-fragile move for this next phase.
It definitely lays out a very specific view and a corresponding strategy based on their interpretation of the data and historical cycles. A lot for you to chew on.
Absolutely. So based on everything we've just unpacked from this source, here's that final provocative thought for you to consider. If history does tend to rhyme, and if the source is right that gold is for war, what exactly does that breakdown in the S&P 500 gold ratio truly signal about the kind of battle that might be ahead for your portfolio? Something to think about.